Welcome to our studios, Dan. I want to ask you about gold. You're one of the gold experts in the market. Gold has been a gold instrument in 2011. It's been up. It brought 10% gain among all the instruments. It was the best. However, it lived a recent correction. Do you expect the correction to continue into 2012, or do you expect an uptrend staying firm?
Well, I think the correction has already worked itself out. I mean, gold's had a very strong beginning of the year. And if you look at the gold chart for the last 10 years and focus on the long term, it's almost a perfect parabola in dollar terms. So these corrections have been quite mild. In fact, if you look at most historical gold bull markets, the higher gold goes, the more violent the corrections become. So if anything, I'm surprised that the corrections have been so mild. We'll have more corrections, they'll get deeper, but gold is going to go much, much higher down the road.
How much of a correction do you expect?
Oh, well, the higher it goes, the bigger it'll be in percentage terms. So in 2008, we had a 30% correction. I anticipate at some point we'll get up to 50, 60% corrections, but not yet. Gold will go much higher before that happens.
How is the demand like?
Well, the demand is very, very strong, and the reason is because the Federal Reserve and all central banks, the ECB and other places too, are printing so much money that people are nervous about holding paper currencies. You know, one of the things that Alan Greenspan said recently is that the rising gold price is indicative of people very nervous of holding paper currencies. Now, he said this after he stopped being the chairman of the Federal Reserve, which is ironic because he created most of the policies that created the upturn in gold. But at least he understands why people are buying gold, and that those trends look like they're going to continue, and not just continue, but accelerate.
I'm glad that you mentioned Alan Greenspan. I want to ask you about the central bankers' role, their policy about gold. Are they buying, and if yes, why? And what should we expect more from them?
Yeah, the central banks are buying a lot of gold, and they'll continue buying more. And one of the reasons you can tell that is because as much gold as they buy, if you look at gold in percentage of their foreign reserves, it's stable or declining. And so the impetus for them to buy gold, i.e. reduce their dollar weighting, and they have very few other assets they can buy. I mean, they were buying the euro, that's going away, and there are no other currencies big enough to be a reserve currency, and so they're looking back to gold as a reserve currency.
Is there a difference between the European and the American central bankers' outlook or the policy, their take into this?
Well, I'm not sure. I mean, there are cosmetic differences. I mean, for example, the Federal Reserve, when they do their quantitative easing, they go out and buy the bonds directly from the market. The ECB says they're not buying bonds. Of course they are. But most of their policy is the recent policy changes they've made. They said, hey, banks, you go buy the bonds and you can give it to us as collateral and we're lending you money against it. So they're not actually buying the bonds themselves, but they're financing the banks so the banks can buy the bonds. It's almost the same thing. If you look at the balance sheets of the Federal Reserve and the ECB, again, the asset sides look like parabolas or worse. They're going straight up. And so both banks' policies, and these are the two major central banks of the planet, both their policies are very gold positive.
Coming from the major players, let's go to the major investors. Let's look at the big investors, like George Soros. He wanted to get out of gold before even 2012 started, towards the end of 2011. What do the big investors are doing? What is their position? What do you see in the market in terms of the trend?
Yeah, I think the big trend for the big investors in gold, and little ones too actually, is the desire to hold physical gold. I think especially after the collapse of MF Global, people have realized that if you have a paper claim on gold, and your counterparty goes down, you lose that claim. And so, for example, the University of Texas took $1 billion of gold, and they took it in physical delivery, sitting in a vault somewhere in New York. No one knows where.
Yeah.
So I think
nobody knows it.
Well, presumably the custodians know where it is. But I think, you know, if you think about, for example, GLD, which is the way most investors gain exposure to gold, and what you're really buying is you're buying an equity entity that's the beneficiary of a trust that has a custodian and has sub-custodians. So good luck finding the gold if something happens to any one of those counterparties. And one of the main functions of gold is to eliminate counterparty risk. And when you hold gold in paper form, where it's a claim on someone else, what you're really holding is the counterparty risk of that entity. So I think that's the trend that you see for most gold investors, is they want the physical gold and they want possession of it.
Interesting. Let's talk about more investing. This allure of gold is about 1,000 years old, and this precious metal has been attracting the young ones, the 20s and the 30s, young and restless. How so? Why is it attracting a more younger population?
Well, I think gold actually lure is about 3,000 years old, or at least maybe 10. But you know, it's interesting. I'm friendly with a couple of coin dealers here in New York, and I was talking to one of them who's been around for a while. What he told me was in the 70s, most of the gold buyers were people in cash businesses. So taxi cab drivers, dry cleaner, people had cash, and the inflation was so much that they didn't want to hold dollars. So they would go in and they trade their dollars in for gold on a weekly basis, whatever it is. He said, in this cycle, this time, it's not cab drivers, it's young professionals, young Wall Street professionals, and they wire in hundreds of thousands of dollars at a time and walk out with a suitcase full of gold. And the reason is because we haven't had a lot of price inflation yet. So the guy in the street who has a cash business hasn't really felt the pain of the central bank printing it. But the people who work in the financial industry, they understand all of the problems that are coming down the pike, how shaky the bank system is and everything else. So they want to get their money out of the banking system and into something hard and physical that they can touch.
You said the guy on the street.
Yeah.
You've been to Turkey, you told me before this show, and you know the mentality of the Turkish people too. We call it under the pillow. We buy the gold as an investment, we save it, we put it there as a security. Do you see the same kind of trend in the United States as well?
Yeah, I do, but it's just starting, right? I mean, most Americans, they buy the gold coin and they put it in their safety deposit box in the bank. But the whole reason to buy gold is to hedge against the failure of the banking system. So having your gold in the bank, it makes no sense. Right? You want it. I don't know if you want it in your pillow. Don't tell your friends where it is.
Or in your cash, in your deposit.
In your socks, or who knows where it is. But there's a lot of midnight gardening going on in the United States. But I think in other countries like Turkey and India, places like that, people understand gold. It's been around for thousands of years, and they want to hold it. In the U.S., gold hasn't really been an issue since the 70s, and people haven't really held gold since the 30s. And so no one really thinks about it, and I believe the percentage of Americans who own gold coins, not jewelry, but actual coins, is only about 2%. So, I hear a lot of chatter about how gold is in a bubble and it's going to pop. A bubble is when, not your crazy uncle has some gold. It's just when you have gold and you're telling your friends which dealer to go to buy more gold.
So there's no bubble yet?
That
hasn't been, okay. No. I feel like you like the gold.
Yeah, absolutely.
So let's talk about the companies. Gold has been going up,
Yeah.
but I don't see the parallel shift in the gold ETFs or the mining companies. Why are they lagging? Why there is no parallelism in terms of the upward trend?
Yeah, well, the ETFs have performed pretty well, and they do have accumulated a lot of gold, but I think
but
that's tapering off.
Right?
I think it's tapering off as people realize they don't want to hold gold in an ETF; they want it in physical form. In terms of the miners, it's interesting. FDR revalued gold in this country in 1933. It took 3 years.
FDR.
Yeah, in 1933, he revalued it from $20 an ounce to $35.
We got to tell this to our Turkish audience about FDR.
Franklin,
exactly.
He confiscated Americans' gold. He made it a felony to hold gold. So it was drugs, kiddie porn, or gold, all the same crimes. But it took 3 years for the mining companies really to start taking off after that. It took that long for the earnings to play into the shares and for investors to believe these earnings were going to continue. And if you look at our own gold bull market, one of the features most people don't understand is that from 2001 to 2008, gold quadrupled, oil quintupled. So the cost of mining actually went up faster than the gold price. So the margins were actually shrinking. And that's why gold companies haven't done very well. Since 2008, that trend has reversed. Now gold is going up faster than the cost of mining it. And what that means is that the earnings of these companies are going through the roof. The equities haven't responded yet. They're going to. If you think about Newmont, the dividend is over 2%. To get that in a treasury, you have to go out 15 years. Which would you rather own? A 15-year treasury, which is almost guaranteed to lose value as inflation kicks up, or a company like Newmont that can redo its earnings and its dividends as gold price goes up with inflation.
Perfect. Our time is up, but thank you so much for coming. Thank you for these valuable comments.